Good morning, everyone. So today I'm discussing my topic, the chapter 4, which is asset liability management. Asset liability management. So asset liability management is a crucial practice for financial institutions, corporations, and even individuals to effectively manage financial risk associated with mismatches between assets and liabilities. So it means it is also the simultaneous management of both bank assets and liabilities for the purpose of maximizing profits, mitigating interest rate, providing liquidity, assuring its capital adequacy, and enhancing the market value of the bank. So first, we have an overview of market rates of interest. So first, we have an interest rate and price risk. So price risk encompasses the possibility of losses in the value of an asset due to factors other than interest rate changes. So for example, if a company announces disappointing earnings, its stock price may decline. Similarly, if a natural disaster disrupts the production of a commodity, its price may rise due to decreased supply. And also, interest rates represent the cost of borrowing money. They are expressed as a percentage of the principal amount borrowed and are typically quoted on an annual basis. Imagine you own a bond that pays a fixed interest rate of 3%. If interest rates rise to 4%, newly issued bonds will offer a higher return. Investors will demand a higher price for your bond to compensate for its lower interest rate, leading to a decrease in its value. And next is income risk. Income risk is the possibility that the income generated from an investment will decrease, often due to changes in interest rates or market conditions. For example, imagine you invest a bond that pays a fixed interest rate of 4% annually. You're counting on that steady income streams. However, if interest rates rise in the market, new bonds will be issued with higher interest rates. This makes your existing bond list attractive to investors, potentially causing its value to decline. As a result, you might receive less income than you anticipated, even though the bond itself hasn't defaulted. And next is liquidity risk. Liquidity risk is the potential for an investment, asset, or company to become difficult or impossible to sell quickly at a fair price. This risk arises from the inability to convert assets into cash readily, potentially leading to financial losses or disruptions. So imagine you own a valuable piece of art, but you need to sell it quickly to cover an unexpected experience. However, finding a buyer willing to pay a fair price within your time frame might be challenging. Next is fixed versus variable rate loans. So fixed rate loans, the interest rate stays the same for the entire loan term, offering predictable monthly payments. So like a steady stream, your payment stays consistent, helping you budget with confidence. However, if interest rates drop, you might miss out on lower rates. And then variable rate loans. The interest rate fluctuates based on a benchmark rate, the prime rate, leading to varying monthly payments. So it's like riding a roller coaster. Payments could go down if rates fall, but they could go also up if rates rise. This can be beneficial if rates decline, but risky if they increase. And the last one is repurchase agreement. A repurchase agreement, or repo for short, is a short-term borrowing agreement where one party sells securities to repurchase them at a specified future date and price. So think of it as a secured loan where the securities act as collateral. The party selling the securities, or the borrower, receive cash and temporarily transfer ownership to the other party, or the lender. The lender provides the cash in exchange for the securities, which act as a collateral to mitigate their risk. And then the effect of interest rate risk on income market value. So there are some effects of interest rate risk below. So first is interest rate risk primarily affects the market value of fixed income investment, not the income stream. And then rising interest rates lead to a decrease in the market value of existing bonds with lower coupon rates. Next is the impact of interest rate Risk is greater for bonds with longer maturities, higher durations. And the last is investors can mitigate interest rate risk through diversification, hedging strategies, and adjusting their asset allocation. And then the managing interest rate spreads. To effectively manage interest rate spreads, financial institutions can employ several key strategies. So first, we have an asset liability management, interest rate derivatives, duration matching, stress testing, and diversification. So asset liability management, aligning the maturities and cash flows of assets and liabilities to mitigate interest rate risk. And then interest rate derivatives, utilizing instruments like swaps and caps to hedge against interest rate fluctuations. And then duration matching, ensuring the duration of assets and liabilities is aligned to minimize risk exposure. And then stress testing, simulating interest rate changes to identify vulnerability and assess risk management effectiveness. And the last one is diversification, spreading assets and liabilities across different maturities and interest rate profiles to lower overall risk. And then duration gap and economic value of equity. So the duration gap is a measurement of a bank's exposure to interest rate risks. The duration measures the sensitivity of a financial institution's net worth or equity to change in interest rate. Duration is a way to measure the sensitivity of financial instrument like a bond or loan to interest rate changes. A longer duration means the value of the instrument is more sensitive to interest rates. And the last one is duration gap and economic value of equity. So there are three parts under the duration gap and economic value of equity. So first we have immunization. So immunization is a strategy to make your portfolio insensitive to interest rate changes. Second is duration has limitations. So duration is not a perfect predictor of interest risk. And the last one is earnings simulation models and stress testing. Tools to assess the impact of different economic scenarios on an institution's financial performance. And this is the last part of my topic, and that could be all. Thank you.